Welcome to this explainer. Today we're jumping straight into a financial autopsy on On Holding's massive single-day plunge. Look, this is a brand that has been absolutely red hot in the running shoe market, but they just slammed into a brutal reality check on Wall Street.
Okay, let's dive into this staggering 20% crash that totally shocked the market. I mean, a 20% drop in a single trading session, that's exceptionally rare for a company that's been an absolute darling of the footwear sector. That kind of aggressive, instantaneous sell-off demands our immediate attention to figure out exactly what broke.
The stakes here are incredibly high. The fallout literally wiped out over $2 billion in market cap in mere hours. To put that into perspective, this massive drop even temporarily erased tennis legend Roger Federer's billionaire status, just given his heavy early investment in the brand. The stock was punished relentlessly throughout the session, ultimately bottoming out at a super painful new 52-week low of $30.11.
But here is the crazy paradox we really need to unravel today. They actually beat earnings expectations, right? So what's really going on here? How does a company beat profit estimates and still lose a fifth of its value in a matter of hours? We have to ask, is this the beginning of the end for the hottest brand in running? Or is the market just wildly overreacting and handing us a massive gift?
Section 1. By the numbers. Let's look at the good, the bad, and the ugly to understand the data that triggered this crash.
You know, looking at the Q2 numbers is kind of like looking at a split screen. On the good side, we've got a rock-solid earnings per share beat coming in at 0.31 Swiss francs, which easily topped estimates. Even more impressively, their gross margins actually expanded to 65.4%. But then there's the ugly reality hitting the market, a revenue miss of about $36 million against expectations. And the ultimate catalyst for the sheer panic, management slashed their full-year guidance from at least 23% growth down to the low 20% range.
Before you assume the sky is falling, however, you should know the underlying demand is actually surging in some key strategic areas. Direct-to-consumer sales, up a massive 34.3%. Apparel, which proves they're successfully diversifying beyond just shoes, surged 56%. And the Asia-Pacific region exploded with 55% growth. This is a big deal because APAC now makes up over 20% of their total sales, proving their whole global expansion thesis is actually working.
Section 2. The real strategy problem. Let's dive into the execution and the hidden motive behind this sell-off.
So, the core issue isn't actually a lack of consumer demand. It's the premium valuation. See, when investors price a stock for absolute perfection, expecting high growth, expanding margins, and constant market share gains, any slight deceleration triggers a massive repricing. It's like a rubber band snapping back. When the narrative shifts, the valuation multiple violently contracts. The market just absolutely refuses to pay top-dollar multiples for a company that cuts its forward guidance, even if it's just by a few percentage points.
But here is the massive nuance that the scary headlines completely missed. Management intentionally pulled back on North American wholesale. Actually, scratch that. They slammed on the brakes on purpose. In a really promotional retail environment, they are deliberately avoiding destructive discounting. Why? To protect their premium brand positioning ahead of major new product launches later this year. They are basically refusing to cheapen the brand just to hit a quarterly target.
This quote really hits the nail on the head. Choosing short-term revenue pain for long-term brand health. They are consciously accepting a hit to their revenue and dealing with some Q1 inventory buildups to make sure the brand stays healthy long-term. It's a super smart strategic move for the lifespan of the company for sure, but it sets up a really harsh tension between management's long-term vision and Wall Street's notorious short-term impatience.
Section 3. Following the smart money. Let's look at insider actions to see what the heavyweights are doing while retail investors panic.
Technically speaking, the chart is broken. The stock is plunging well below both the 50-day and 200-day moving averages right into deep oversold territory. By purely technical standards, it looks pretty bleak, right? But the actions happening behind the scenes tell a completely different and honestly fascinating story.
The battle lines among institutional heavyweights are clearly drawn here. While funds like Sage Capital and the Ohio Pension Fund slashed their positions by roughly a third, major players like Morgan Stanley and BAMCO were actually adding to their stakes. But the absolute most critical data point? The insiders. Company insiders bought 180,000 shares last quarter. Both co-CEOs put their own money on the line, buying heavy chunks at prices between $36 and $38 a share, which is significantly higher than the recent bottom.
Furthermore, the average analyst price target still sits around $52, representing a massive 35% upside from post-crash levels. But a quick word of caution for those following the street.
Analysts are notoriously slow to update their models, so definitely watch closely for impending downward revisions as Wall Street finally accounts for that new, lower guidance.
Section 4. Bull versus bear case. Let's synthesize this information by weighing the arguments side by side.
It's a classic Wall Street tug-of-war. The bulls have a very compelling story. Undeniable brand momentum proven by DTC growth, elite 65% margins, massive untapped opportunity in APAC, and the fact that the CEOs are literally eating their own cooking by buying stock. But the bears will immediately counter with cold, hard facts. Overall growth is decelerating, there's a lingering wholesale slowdown with elevated Q1 inventory, and a brutally competitive landscape against giants like Nike and heavy hitters like Hoka. Plus, let's be real, even after the drop, the valuation isn't exactly cheap.
Section 5. What to watch next? With the stock beta over 2 bringing intense volatility to the table, here is your playbook going forward.
If you're a long-term investor eyeing that $30 stabilization mark, treat these 4 forward-looking metrics as your ultimate checklist to confirm if the premium story is still intact. Number 1, does direct-to-consumer growth accelerate next quarter? Number 2, how quickly does North American wholesale recover? Number 3, their new product launches later this year absolutely have to be hits. And finally, number 4, watch those analyst target revisions to see where Wall Street's expectations finally settle down.
Look, the long-term narrative for this company, premium running shoes, global expansion, aggressive apparel growth, hasn't fundamentally changed. It's simply a matter of the market repricing the stock for slightly slower but intentionally protected growth. So as we wrap up this explainer, I'll leave you with this final crucial question based on everything we've unpacked today. At $30 a share, amidst all this deliberate short-term pain, are you buying this dip or are you staying safely on the sidelines? Keep analyzing the data and I'll catch you in the next explainer.